Andries, let's start off with you. We saw revenue increasing by 11.2%. Headline earnings per share, though, slightly lower coming through. Take us over the period that was, because Gauteng, KwaZulu-Natal looking relatively strong, but the likes of the Eastern Cape looking slightly weaker.
Yes. Yeah, it was a very interesting half year. The first quarter was very tough. Yeah, if you can remember, we had an extended Easter break where the construction sector almost came to a standstill for 2 weeks. And then that was followed by some strikes at Medupi and Kusile, and there were strikes in the transport sector. So it was a difficult first quarter for us. The second quarter came back very nicely, and the half year ended up almost flat on the previous year. We were also helped a lot by our recent acquisition of Glen Douglas dolomite mine.
And that actually doing quite well and in line with expectations that came through.
Yes.
Tell us a little bit more about how it's going to contribute to earnings down the line.
Glen Douglas is a significant asset in our portfolio. We bought it from Exxaro at the beginning of the year. It was small in their business. It's a big mine in our business, and we are busy with the turnaround. We've just placed an order for the upgrade of the mining fleet, which will reduce costs significantly. We're doing some other upgrades on the operation, and we are expecting a lot to come from that investment.
Keith?
Well, it's definitely a promising investment, Andries. I was just wondering, because you guys obviously have the mining and aggregate segment, which is a major contributor to both revenue and profits. From Glen Douglas' perspective, because it's obviously a higher margin mine, but how much is it actually contributing in percentage-wise to that segment?
At the moment, the aggregates business is about 90% of our operating profit coming from the aggregates sector, and roughly about 30% of that was contributed by Glen Douglas at this stage.
And it still seems like it's almost in ramp-up phase as well.
Yes, it really is. It's in the ramp-up phase.
And you've also been awarded a few roads contracts.
Yes.
Going forward in various regions.
Yeah.
Give us more insights into that.
Yeah, we've seen a change in the road building sector from the way we look at it. 5 years ago, government or total spending on roads, national and provincial, was about 10 billion per annum. That has gone up to about 30 billion per annum, and that's the level that it seems to have tapered or flattened out at. But the difference is, 2 years ago it was on the Gauteng freeways and it was on the big projects in and around the cities. That has now changed, and it's moved out of the cities to the urban areas. Many contracts around the country, and it's very exciting because that fits our business model perfectly.
Ready mix also doing quite well. Increased volumes coming through. This is obviously very optimistic. We know that the cement industry, for example, is going under pressure.
Absolutely. First of all, ready mix actually made a profit, which says something.
Yes, indeed. So we're seeing a significant recovery within that region, but then you've got the Western Cape that is still underperforming. And when we say, making a profit in this division, are you expecting these? Are you expecting this performance to come through going forward?
Yes.
Is it sustainable?
Yeah, the Western Cape in the aggregates business is doing very well. The ready mix business is flat.
Fantastic. Andries, we have to leave it there. Thank you so very much for joining us. Much appreciated for your time. Andries van Heerden, the CEO of Afrimat, and of course still with us is Keith McLachlan from Thebe Stockbrokers. Your view, let's give us more views on Afrimat, and is it a buy for you? You said earlier that you actually like the stock.
Yes, the Thebe Stockbrokers, we definitely have Afrimat rated as a buy. So it's one of the top picks. Personally, in the construction sector, you need to view it in relative context. Flat results in a sector where we've seen some of the biggest companies have huge losses. This is actually relative outperformance on profitability level.
Business Connection out with a trading update as well.
Yes, it's a little disappointing trading update. But the company's been impacted by a range of things, and also it's been on a bit of an acquisitive spree. So there's a lot of once-off costs coming through that's obviously impacting this trading update.
And I think another cautionary announcement actually.
It's been under, it issued cautionary, I think it was 2 months ago, and it's been under the cautionary for quite a while.
You said disappointing. Does that mean that you would not be buying the share, or do you hold the share?
No, we actually downgraded them to a hold at this point. It's a little disappointing. They haven't delivered on the promises. There's still longer-term potential there, but it's definitely being impacted in the short term, and that worries us.
Basil Reid winning a 2.7 billion rand airport contract. That's fantastic news. And we keep talking about the order books of these construction companies, but more issue coming through with the likes of the margins that are going to be experienced within that.
Exactly, that's the point, is that order books are just like revenue, they're eager, but is it profitable? Are they profitable order books? What's nice about this project is it not only it will add, because that 2.7 spills across the next 4 years, adds about 10% to Basil Reed's revenue for each of those years, but there's actually a maintenance aspect, 450 million for the next 10 years thereafter. That adds a bit of an annuity cash flow into Basil Reed, which is quite nice.
Is it still too early to head into the construction stocks though, Keith?
I don't know. If people are telling you it's too early, then it's probably the right time.
Okay, so what are you doing? Tell us what you're doing with the construction stocks.
Well, construction stocks, we are two top picks in that sector is Stefanuti and actually Afrimat. We like the quality of the companies as well as their Stefanuti's got exposure into Africa, and Afrimat's got a very unique exposure to the N1, N2 winelands region, or the roads project in the Western Cape, that is. I wouldn't make it a general sector buy. But I would definitely be looking very seriously at those two counters.
Okay, in the small cap space, Keith, what is your preferred play right now? Are you even cognizant of what is happening in the Eurozone? There's so much drama and tension, and we, of course, are very much linked to this globalized economy. Well, would you be committing?
The reality is that a lot of guys miss the trees for the forest. And when you're looking at the macro picture, everything looks like, humanity is going to end, the world's over.
Yeah.
But in reality, businesses will always continue, and the best ones will continue to grow. So it's actually starting to become a stock picker's paradise. And we saw that when equities had a strong run this quarter so far, and it's more than likely going to continue. So what I like plays that are not overly globally exposed at this point, because then I can narrow down the variables and understand exactly what's going on there. In that particular scenario, I actually quite like Clover. And I still maintain undervalued as a very defensive proposition. And once again, I can understand the local scenario. It isn't all over the world. It's not supplying into Europe. It is just a geographic play and an undervalued asset.
We keep talking about small caps, and we talk about specific stocks within all these interviews that we conduct. Tell us in terms of how the overall small caps have been performing relative to the mid caps and the top 40. Can you give us an indication of what's going on?
Absolutely. Top 40 is basically flat to a little up. I think it was, last I checked, there was a % or 2 up. Mid caps are down, because this could, in volatile markets, this could be wrong. I checked this last week. So I need to, that's the disclaimer.
Refocus on that. Okay, we'll get more info from that.
Absolutely. Mid caps were flat, and actually small caps are down 5% for the year. But that's just inherent of their more volatile nature.